Good afternoon, everybody. My name is Austin Shear. I'm the manager of digital marketing at Generis and Associates, and I'll also be your host for today's webinar on the PPP loan forgiveness. In just a few minutes, I'll be handing off the mic to Pat and Kellen, and they'll give about a 25-minute presentation of everything you're going to need to know with some examples. Following that will be a Q&A, so I'm going to cover what that entails really quick. So after the presentation, there will be a Q&A section. In your Zoom call and the webinar at the bottom, there is a little Q&A button. Please write your questions in the Q&A section so I can make sure that I get to all of them. In your question, please designate if you would like me to read your question. If not, we're going to pull you in and you'll be able to ask your question and any other follow-up questions to discuss with Kellen and Pat live. So that's all I've got for you. Let's not waste any time. I'm going to hand it off to Kellen. Kellen?
Thanks, Austin. So before we get started, we have a couple of items that we just want to mention up front, not necessarily on the loan forgiveness topic, but they're important to keep in mind. So first off, since our last webinar on Friday, there's been some changes. Information moves quickly. The Senate just yesterday passed a new stimulus package that's going to provide additional funding for both the PPP program and for the EIDL loan program. In that package, there's $310 billion set aside for new PPP loans. There's $10 billion set aside for EIDL loans. Again, this isn't final yet. It still has to go through and pass the House of Representatives. So information in there could change, amounts could change, but that's what we're looking at right now. I know a lot of people are still waiting, if you have applications that are pending, waiting on that additional funding. So it is important to know that. Another thing we want to mention, and it's something we've been getting a lot of questions on, is for those who have applied for the economic injury disaster loans, some people had filled out that pre-application form and never heard anything else, and all of a sudden started getting a deposit into their bank account for that EIDL loan. Even though they didn't complete the application process, some people did start receiving money, and a lot of those people actually had already gone ahead and applied for the PPP loans as well. So now they're sitting there thinking, you know, what do I do with this money? I didn't disclose it on my PPP application. What should I be doing? And we actually did consult with the SBA about what they recommend for this. Best thing you can do is if you did receive any EIDL loan and you now have a PPP loan, go ahead and disclose that with your bank. Make sure that they know what happened. Maybe if you didn't fill that out on your application because you weren't expecting the funds yet. We just want to make sure that we're being upfront with the bank and the lender so that they know what's going on, that, you know, we weren't trying to hide anything, but we did receive this money. So it's a good idea to go ahead and let them know that if you did receive EIDL funds and you're still waiting on your PPP funds, or you've already received that. So with that being said, we're going to go ahead and get into today's topic. One of the things we want to keep in mind, these are guidelines based on our interpretation. These aren't necessarily final things that were in the law, but based on what they've provided information so far, things we've seen so far, this is our understanding of it. So main thing up front we want to talk about are cautions, being cautious about your loan forgiveness, what you're doing with those funds. Main thing to keep in mind is forgiveness is not guaranteed. If you've received funds for the PPP loan, it's not guaranteed that all of that loan is going to be forgiven. In all actuality, a lot of businesses who may get PPP funds are only going to get part of their loan forgiven. It's not going to be the full amount. It's not to say that some businesses aren't going to have the full amount forgiven, but a lot of people are going to fall somewhere in that middle ground where you're getting a portion of it forgiven. So it's good to keep that in mind. We want to make sure that we're laying this out here for you, things you're going to be thinking about or should be thinking about if you received money or if you're anticipating receiving some of the money that's coming in this next package. So the loan amount that's not forgiven, keep in mind that's going to need to be repaid. So make sure those funds are being set aside. You're in good shape to pay those funds back if there's a portion that isn't forgiven. We're going to go ahead and we'll take a look at an example of what happens with a PPP loan if you're taking the loan funds, but you're not spending it on qualified expenses. So here's one example of that. We've set up an amortization schedule. Let's say this client went ahead and borrowed $150,000 on their PPP loan, got it approved, received the funds, and took those funds and just went ahead and spent them on something not related to this. All of a sudden, once that 6 months is up and you have to start making those repayments on this loan, they're going to have a full balance due. None of that amount is going to get forgiven. They have a $150,000 loan that needs to be paid back over those next 18 months. What does that mean in monthly terms? You're looking at a monthly payment of just over $8,400. That's an amount that a lot of businesses would not be able to pay back if they've gone ahead and used those funds somewhere else. So that's a really important reason that you want to keep in mind. Okay, if I'm not using these for qualified expenses, I want to make sure I have that money set aside to be able to pay that loan back. Otherwise, you're going to end up with a really big monthly payment, and you're not going to be able to afford to make those. Next, we're going to go over some definitions of important items that Pat's going to go into more detail later, but we want to make sure you have a good understanding of those up front. First item is your origination date, and that's just going to be the date that your loan was approved or that you closed on that loan. That's going to be an important benchmark in some other determining factors, but it's not necessarily the date that you receive the funds. From what we're hearing, a lot of times the date that you do receive your funds are going to be in close proximity to that approval date or that closing date. Typically within about 72 hours or so, hopefully 2 to 3 days, you'll receive those, but that's an important date to keep in mind. Another thing we want to talk about are full-time equivalents. So what does this mean? Full-time equivalents are the number of full-time employees that are on your payroll. There's going to be a few different time periods that we're going to measure this over. And it's also going to include hours for part-time employees. So if you have employees that aren't necessarily full-time, those partial hours that your part-time employees work are going to be counted into that factor. And that's going to be something really important that Pat's going to touch on later as well. Your covered period, what period is that? It's the 8 weeks after your loan origination date. So that's going to be an important period for measuring some of your expenses. So you want to keep that in mind. And then the test periods. There's actually 2 separate test periods that are going to be important. First one is February 15th of 2019 through June 30th of 2019. And the second one is January 1st of 2020 through February 29th of 2020. And what those 2 test periods are going to do is give the covered period a place to reconcile to or compare to. And you're going to be able to actually pick which one of those is more beneficial for you. So as the borrower, you do have that option of choosing which period benefits you the most. Next, we're going to take a look at some of the limitations on the loan forgiveness. So again, it's important to consider how much of this loan that you're receiving is going to be forgiven. The maximum forgiveness amount is going to be 100% of the loan principal. So you're not going to get more forgiven than you've taken out for the loan. Next, your reduction in full-time equivalents. What this means is you want to make sure that on a benchmark date of June 30th, 2020, you have the same or more employees that you did compared to the test period. So if you had 8 full-time equivalent employees during the test period, but you only have 6 during the covered period, there's a reduction in your forgiveness amount based on in proration to the number of FTEs that decrease. So if you went down by 25%, your forgiveness amount is also going to go down by 25%. So those are important numbers to keep in mind. And again, Pat's going to cover that in a little bit more detail next. Qualified payroll does not include wages for anyone that earns more than $100,000 annually. So looking at those per month and per week payments, $83.33 per month, $19.23 per week, any amounts paid over that is not going to count towards your qualified wages for this purpose. Lastly here, reduction of salary. So if you reduce an employee's salary or their rate by more than 25%, so for example, if you're paying somebody $20 an hour and you reduce them down to $10 an hour, that difference that is more than 25%, you're going to end up having a reduction in your loan forgiveness because of that. So that's really important to keep in mind. You don't want to be reducing employee pay by that because it's also going to reduce your forgiveness amount. This doesn't apply to anyone earning more than $100,000. So you had someone earning $200,000, you reduce it to $100,000. That's not going to hurt your forgiveness amount. But once you drop below that $100,000, any decreases more than 25% can certainly hurt you in that area. Next, we're going to talk about some of the best practices, what we recommend that you start out doing right now. We don't want you to waste any time on this. So first off, estimate what you expect your forgiveness is going to be. And this is something that we're certainly going to help you with. Based on your knowledge of your payroll and your expenses right now, get in touch with your account manager. They should be reaching out to you to help you get started on this. But we want to get an idea of what your forgiveness amount it should look like based on your current payroll, your current expenses, and what's going to look like on those upcoming expenses. Next, you want to estimate your full-time equivalents. So we're going to look at the 2 test periods that we talked about before. How many full-time equivalents did you have during the first period? How many in the second? And we're going to look and see which test period is going to be the most beneficial for you. We want to keep that number lower. So when you go ahead and compare the covered period to that, you're able to match that up. Estimate what your full-time equivalents are going to be on that benchmark date, the June 30th of 2020. Again, we're going to compare those to the test periods, and it's going to help determine if there's a reduction in your forgiveness amount. We want to monitor your actual expenses, make sure that you're on track. So this part's really important. We don't want to get down the road to when we're looking at forgiveness and have to go back and recreate all these records of where you spent the money on. We want to monitor your expenses as you go along. So you have real-time tracking of what you spent your money on, whether they're qualified expenses, how much of that loan is remaining that may not be forgiven. We want to make sure we're out ahead of that and not trying to go back and figure things out at a later time. Last best practice point we have for this, good idea to keep a separate escrow account. This was not specifically mentioned as a requirement, but we feel that's a really good way for you to, one, again, monitor your expenses, monitor your forgiveness, and just stay on top of things. If you have things in a separate account, those PPP funds can only be used towards those qualified expenses. It's just an easy way to keep track of those. As you spend money, you can move that money from your escrow account to your operating account to reimburse for those payments. But again, it's a good idea to keep those funds separate if you're able to. If you have a second account, it might even be worth opening up a new account if you don't have one. Again, it's going to help you track your qualified expenses, and it's also going to leave any funds in there for a non-forgivable portion. So if you get to a point where you've exhausted your forgivable portion, at least you still have those funds sitting in that separate account to go ahead and repay the remainder of your loan that is not going to be forgiven. Next, I'm going to hand it over to Pat. He's going to go ahead and just give some more in detail examples of loan forgiveness, tracking expenses, and determining full-time equivalents. So with that being said, I'm going to hand it over to Pat.
Thanks, Kellen. Great job. All right, so we'll move on to some examples. I'm going to show you what Kellen was explaining. You know, I think it's a little easier to understand that way. And we hope to get all of you guys in front of this so that you maximize your forgiveness. And God forbid, you know, we want to make sure nobody gets in trouble. I don't want to see anybody refinance their mortgage into a 2-year loan, even if it is at 1%, right? So let me share my screen and I will go through his points one at a time. Okay, so in this, his first best practice was estimate loan forgiveness and make adjustments if possible. So your account manager will do this with you. They're going to start a sheet for each one of you. We'll know the dollar amount that you got. And in this example, the client got $71,717. After the first payroll of the covered period, so after the loans originated, you've cut a payroll. What we'd like to do is look at that payroll, and if it's representative of what your payroll is going to look like for 8 weeks, we're going to extrapolate it out. So, you know, based on this first payroll, it looks like you're going to have $55,848 in payroll expenses. Health insurance is going to be $1,071 for the 8 weeks. We also pay rent, and this is based on our average utilities. We did this in some of our earlier webinars. The difference is back then, we were looking at what you actually spent last year. And now what we want to look at is what we're going to spend over the next 8 weeks. Because it might be different, right? Because business is down and places are shut down and what have you. And so based on this hypothetical situation, this person's maximum forgiveness is actually going to be $64,919. You have a payroll target. So any forgiveness that you get, it has to be 75% for payroll. So a simple example is if you spend $20,000 on payroll, your maximum forgiveness is going to be $26,667. And all I did was I divided 20,000 by 75% to get that number. So you can see we tested for that. He's fine based on payroll. His payroll's 88% of his forgiveness. And so he's looking at maximum forgiveness of about $64,919. Well, he borrowed $71,717. And so that's going to leave a remaining loan amount of $67.98. The reason we want to do this right away is it might actually influence your behavior, right? So maybe you were thinking, well, maybe we'll try a sales guy, get somebody doing cold calls, or maybe we'll hire somebody to revamp our technology or whatever. And so if we did that, what would that look like? Well, it's pretty simple. I mean, so if you hire that guy and you're telling me that guy's going to cost you $6,000, now in advance, we could actually make decisions. If we wait until the 9th week, there's nothing that you can do about it anymore. But now that 6,000, at least that first 8 weeks of that staff member, that testing period, I mean, you're getting it covered. So do take the time to estimate where you think your forgiveness is going to land with your account manager now. And that's how we're going to start these sheets with our clients. The second thing Kellen talked about was the FTEs. This is pretty important because people could get wrong ideas. And I've already heard clients talk that have wrong ideas, because I know that there's information out there that, well, you've got time, if you laid some people off, you've got time to get people onto the payroll. And I think June 30th is the date that they're saying you have until June 30th to get your employees back up. And that's fine. And that's going to work. It's true. You're going to pass that test, but it's a separate test. You still have to spend the money during the covered period. So if you don't spend the money during the covered period, it doesn't matter that you meet the FTE requirement, you're still going to fall short. I'm going to go through a couple little examples of how the FTEs are going to come into play. So he did talk about how there's 2 different test periods. So first, let's look at what would happen if you picked the wrong test period. We're not going to let you do that. We're going to go over your 2 test periods. We're going to pick the right one. But you can see in this hypothetical example, the guy's going to have a remaining loan amount of $2,646. The first time period, he had 13 full-time equivalents. As we did the testing, we determined that he had 13 full-time equivalents back in 2019. But right in the beginning of this year, he laid a couple guys off. Before anything happened with COVID, he let a couple people go. If we just looked at this period's full-time equivalents, you'll see what would happen. We're going to have a reduction of $5,313. Again, we would never let this happen with one of our clients. You're going to choose the right testing period. I'm hoping that they'll have some forms that walk you through choosing the correct test period, but we'll look at it both ways, and we'll look at it both ways now so you have an idea. But let's go down to the 11. It doesn't increase your forgiveness when you have less people than the test period, because now we're assuming we have an extra guy on payroll during that covered period. So that's the gist of what happens when you don't have the same full-time equivalents as last year. But I want to go through a couple other examples. I mentioned that you can't just wait until the end, because then your payroll expenses during that 8 weeks, you have to remember, it's what you spend during that 8 weeks of the covered period that is going to get forgiven. So it's great that we passed the test for full-time equivalents, but if we only spent $20,000, it doesn't matter. And you can't go back in time and spend the money. So you've got that 8 weeks, and that's what's going to drive your forgiveness. So if I only spent $20,000 in payroll, of course, my remaining loan amount goes way, way up. The other thing that I think the other bad ideas I've heard people come up with, and I'll do an extreme example. Let's say I have 3 employees, and between me and the 2 other guys, we make $100,000 a year. And so what you might think is, well, business is slow. I'll lay those guys off and I'll take the 100,000, all the wages, right? Well, that is exactly why they built this FTE test into it. So if I started with 3 and now I have 1, my brilliant idea didn't work out at all. I have to pay all the money back. So they're looking at what you spend, and they're also looking at headcount. you can't just cut your head count way down and spend the same amount of money. That's not going to work. There's two tests. And so that's what he was talking about when he was going over the FTE requirements. Last couple of things he mentioned is that it's really important to monitor your expenses. And I really do love the idea of a separate account. That's what I did. Disclosure, I've already gotten a PPP loan for our company. And the first thing I did was dump it into an escrow account that I had set up. That way I know that if I don't spend it for required expenses, I'm going to have the money to just give back, because I'm not really interested in borrowing money. So let's go through this example. It's the same example that we had on the last page. If this is you, if this is where we land, we are going to want to monitor it. We've set up these sheets for our clients. I do have an escrow balance, so I've set it up here. You can see that, you know, it starts on the actual side. My escrow balance has the amount that I have to pay back because I haven't used it for any forgivable expenses yet. And this is what we recommend you do. So for example, say we got our money on April 15th and it's April 22nd and we're going to do our first payroll. And our first payroll is $7,500. That's what it averages. SUTA, we paid all that in the first quarter. We do not have a retirement plan, and there's no need to make any adjustments because none of our people make over $7,500. There it is. There's your qualified expenses for that payroll. I would sweep those, if you have the escrow account, from the escrow account into the operating account. Might note to yourself that, you know, transferred on 4/20 because you put it over a couple of days before payroll. There you go. So I would transfer that $7,500 into my operating account. Maybe on the same day I paid a utility bill, NIPSCO, $750. Again, transfer from your escrow. You do it right online, $750. Maybe a little memo that it was for your NIPSCO bill. And you could see our sheet is going to track it. So, you know, we're going to set one of these up in your folder, your shared folder, so you'll know at any given time where you're at on your qualified expenses. So get with your account manager so we can get this set up and we can start tracking today if you've already got your money, or within the next couple of days. I'm going to say today, and then these guys are going to get 300 phone calls today, but they'll call you as well. I mean, so we do want to get with you quickly and start to monitor where you guys are with these things, and just not have anyone create a disaster for themselves. So it's great that you got it. And I think most of you will get it, even the ones that haven't gotten it yet. But now be responsible with it. Don't run off to Vegas. Don't refinance a mortgage. You will have to pay it back. And even though 1% is a terrific rate, 2 years is a very short amortization. And with that, I'm going to bring Kellen and Austin back in, and we'll start taking your questions.
Excellent. Great job, everybody. Just a reminder, if you have any questions, to ask them in the Q&A section so they don't get missed. I see a couple of people asking questions in the chat itself. Everything stays much more organized. I don't want to miss any of your questions. So I'm going to start with a question that I had emailed to me before this. Must you hire back your employees furloughed or new people currently collecting unemployment? Or can you add new employees?
Go ahead, Kellen. You want to take it?
Yeah, I was just going to say it's equivalent. So it doesn't have to be the same employees. If you have people that you laid off and aren't coming back, you can hire new people in those positions, and it's going to count just the same. It does not have to be the same person that you're hiring back. And
I would add that I don't think it's the position that matters. It's the head count that matters. You know, the tests are head count in dollars.
Yep.
Yeah. If you've already received the PPP, can you still apply for the EIDL grant? The one I received.
If you've already gotten the PPP, you really shouldn't be applying for the EIDL. You could have gotten an EIDL. The original idea was, all right, and I think the first program that they did was this emergency injury disaster loan. And it had this $10,000 grant, and people right away jumped on that. And then the PPP was supposed to come out. And the idea was, well, if you got that EIDL and you're going to get a PPP, you could roll that balance into your PPP. But if you've already got the PPP, I don't think you should be applying for the EIDL. And for sure, the grant that is involved in that EIDL, it reduces your forgiveness on the PPP. So I'll show on my screen real quick what that might mean using my first example. Here was the first example that we did. Let me take out that extra $6,000 that I was going to bump my payroll up. All right, I'm at 6798 is going to be my remaining loan amount. If you got that EIDL loan grant, and let's say I got, I don't know, $5,000 for an EIDL loan grant, it just increases the amount that you have to pay back. So there's no real grant incentive to go back and try and get an EIDL loan. So if that's what you're driving at, hopefully that answered your question.
Excellent. Our next question comes from Laura Gates, who asks, this is a pretty long one. So on the PPP application, it asks about number of employees. She currently has 11. Will she need to show 11 employees on each weekly payroll, or will they just look at employees at the end of the 8 weeks?
Well, I mean, I think we're going to need to see more guidance on this, but I would certainly hope that they would allow for averaging over the covered period through June 30th or something like that. The date that I know that has been thrown out there is June 30th. I can't say specifically, but I would assume they would allow you to average your employees over the covered period. And we'll certainly update the website and contact our clients and send out an email, even have another webinar if the guidance is wildly different than what we expected. In the meantime, we really don't know, honestly, until we get the guidance.
Excellent. Thanks for the question, Laura. Finally, this is the last of the questions that were emailed to me. When they receive the money from the PPP loan, does it have to be a separate checking account, or could it be a savings account that they can transfer the funds as needed? Does it matter what kind of account they put it into?
Savings would be fine. Savings, checking, it doesn't matter as long as it's a corporate account. You're just going to release the funds really to your operating account as you use them for covered expenses. Yeah. So again, I don't even know that that's mandatory. They haven't said that that separate account is mandatory. I just think it's a really good idea, and we're calling it our best practice.
Excellent. I actually have one more from email, which was, does there need to be any revenue during the duration of the PPP to receive the forgiveness?
I'm sorry, say it again.
Does there need to be any revenue during the duration of the PPP due to the mandatory shutdown?
No, there's nothing in the bill about revenue. You know, that the lack of revenue is the reason that they came up with a program, but it's very specific about spending the money, how you're going to spend the money. So we're basically conduits to our employees. This money is supposed to go to payroll primarily, and they allow for some other small expenses as long as you're paying payroll. But if you didn't have any payroll during the covered period, you'd owe the entire amount back.
All right. Excellent. All right. Let's dig into the question and answers now. This one comes from Lisa Schultz. So as long as I spend the money correctly, I can wait until June 30th to bring the same amount of full-time equivalents back?
Yeah, I mean, my interpretation is they're going to give you some leeway. And again, we're waiting for guidance, but they specifically said they would give you leeway if you've already laid people off and time to bring your payroll back up. And they said June 30th, but I expect more guidance. I mean, the SBA surprised us with the guidance on the bill. We had read the bill and there was some stuff in there that we thought was very inconsistent with the bill and related to 1099s. So we're certainly going to want to see the guidance, but they are saying they are giving flexibility for you to get your people back to work, basically the people that you've laid off.
Yeah. One thing to add there, and I think it's important that what you touched on in your example of it. Even if you have the option of waiting until that June 30th date, that doesn't necessarily mean that you want to, because you need to have enough expenses to be qualified throughout that covered period. If you wait till the end and just hire people back at the end, you're not going to have the expenses to add up on that forgiveness. So it's important that you have both sides of it.
Right.
Excellent. Thank you for the question, Lisa. Our next question comes from Angel Gray Shaw, who I'm going to pull in to talk. Angel, all you have to do is unmute and you can ask your question.
Hi.
Hey,
Hello.
Hi. I guess my question, I have a couple of questions, but my loan was dispersed on Monday, and we have a payroll to pay on the 30th of April for the dates of March 16th through April 15th. Does this count?
I would assume yes. I mean, again, we'll look at the guidance. I generally, they're going to look at it cash basis, because they're going to look for evidence that is going to be cash basis evidence. You know, your payroll run, your wage reports. I mean, your wage reports are done cash basis. So I think that that's how they're going to look at it. Yes,
Okay.
I think yes. I have no evidence to the contrary.
Okay. So the same thing goes for the end. Like typically we would pay our payroll on the 30th of the month, but we would be able to fit 2 more payrolls into this 8-week period, since we have one at the end of May, and we could technically pay one like on the 12th, for example, of June.
Right. So the bill specifically says you cannot prepay expenses. So as long as you are not prepaying expenses, I think it's fine. So if you normally, I mean, the employees earn the money is the point. And so as long as they have earned the money and you're not, you know, paying next month's payroll this month, I think it's right. Yes.
Okay. And the other question I had, I don't know if you want me to ask it right now since I asked it, but we had applied for the EIDL and then didn't hear anything. And then I just received that 10,000 grant like yesterday. Do I have to use that in the same 8-week period?
No, see, it's a completely different grant program. It was a completely different loan. And the one thing you're going to want to do, and we're waiting for, I hope we get more guidance than this, but we did talk to the SBA, just be forthright with your lender, and that is going to reduce your forgiveness. You weren't supposed to get both grants. You were supposed to get one or the other. And so if you got that one, you were supposed to reduce your forgiveness in the other loan, in the PPP, which is for most people a much better grant.
Right. Okay. I mean, I didn't even know what happened to it, and all of a sudden it was just there. So.
Oh, right. I know. I saw it myself. The whole thing was like, get on the list and we'll call you. And then if you successfully apply for this loan, you can get a grant of up to $10,000 within 3 days of applying. And now people are getting the money and they never got a call. They never formally applied for anything. They just thought they were getting on the waiting list. So yeah, I've heard this a lot.
Yeah, that's exactly what happened. I think I applied in like March, and so I don't know. Yeah.
Right, exactly. And so we were telling clients that had started in March or at the end of March, we said, look, if you're going to get the PPP, looks like they're going to be available. When they call, just tell them, look, I'm getting a PPP loan, so I'm no longer interested. They didn't really give you the opportunity to do that. They just dumped the money in your account.
Right.
So we'll just be honest about it and hope that it gets straightened out.
Okay.
Thank you very much for your question, Angel. Do you have anything else to ask?
I think I'm okay right now.
All right. Excellent.
Thanks a lot.
Yep. Our next question comes from Emily Askin. Emily. Oh, that's not Emily.
Hi, Dina.
She snuck in there. Here's Emily. Emily, you just have to unmute.
Hey, how are you guys?
Hey, how you doing?
How are you?
Good. We are in the process of bringing on had been in the process of bringing on a coach trainer for our office. This particular person is paid as 1099. Is that something we could do now, and would be, you know, how would that affect this PPP? Is that something that we could, because they wouldn't be on our payroll, but we would still be paying them, and they would be working in our office, training the agents, you know, so on and so forth.
Well, the 1099s do not count
Okay.
for the PPP forgiveness. They didn't account for so anything that didn't count to compute your maximum loan isn't going to count for forgiveness. Now, you might want to rethink that, though, if this is a short-term position and it just happens to be starting at the beginning of your PPP forgiveness period, right? If
Right.
you're going to hire this person for a couple of months and they're willing to be an employee instead of a contractor, that could help. But it
Okay.
won't help if they're 1099.
Okay.
Thanks for asking your question, Emily. Anything else we can help you with?
Nope. Thank you.
All right. Thank you very much. A couple rapid fire questions. Can you give your employees a bonus with these funds?
As long as it's not a prepayment, I don't see an issue with it. As long as it's not a prepayment and it doesn't push their annualized wages over $100,000.
Excellent. And will this be available on the site after the webinar ends? I can take that one because it's not accounting related. It will. As soon as this is over, I'll be uploading it onto our YouTube channel. So you can subscribe to our YouTube channel. And then I will also be emailing out the YouTube recording to all of the attendees. Thank you for your question, Pam. Our next question comes from Michael Generis.
My brother, Michael.
Go, Mike. Mike, you're live with us. All you have to do is unmute.
So just unmute the button there, Mike, and we'll.
All right, it's actually Lisa Generis's question.
Okay.
Look at that. Why doesn't that surprise me? Hello, Lisa.
I'm telling.
Yeah. Okay, go
We're in
ahead.
the same office. It is his question. He just doesn't want to.
I think it was already asked.
Yeah, I
though.
think you answered it. If you get your disbursement of the loan in the middle of the week and your pay period goes from Monday to Sunday, but your loan is dispersed in your bank on a Thursday, how do you track? How do you track those funds? Is it the weekly payroll or just the 3 days after it?
No guidance on this. I'm assuming cash basis is going to be fine.
Okay, and then our second question is, when you're considering what test period to use, is it only for full-time employees? But you would also have to consider your payroll during those test periods and pick out of both of those numbers what would be best for you.
That's right. So you're going to total up the hours. So let me do a real simple example. If I've got two guys that work 50, 60 hours a week, they're salary guys, right? They count as 40 hours each. Full-time people and full-time plus people are 40 hours each or something like that. We looked at a bunch of different ways they've computed FTEs in the past. Sometimes they've said 30 hours, sometimes they've said 40. It doesn't matter because it's going to be a match to a match. So whatever it is, let's say 40 hours is a full-time equivalent for this example. Those two guys are 80 hours. And then I've got 3 part-timers that between them, they work 40 hours. So I've got 5 people, but I've got 3 full-time equivalents. You see the way it works?
Yes. But when you're factoring what test period to use, you figure out your FTE in both test periods, but what about your payroll? Is your payroll just an average of that time in the year and it doesn't matter what happened in those 2 test periods for your payroll?
Your payroll is already baked into your loan. So they've already factored that in. And so your forgiveness is going to be based on what you spend now. Your payroll is how they computed your maximum loan.
So when I'm deciding between the test periods, it really is just about FTE.
Right.
Right.
Got it.
Yep.
Got it.
Correct.
Thank you.
Yep. Is that all you guys have?
That's all we have
That's
for
it,
you.
thanks.
You guys want to bicker a little more before we let you?
Yeah,
Yeah.
we definitely do.
You're gonna have to cut that out.
Yeah, we'll cut it out of the recording.
Thanks for your question, Mike and Lisa. Our next question, if you pay your own property company rent, do you have to have a lease for supporting documents?
I would absolutely want to see a lease. Yes.
Mhm.
I think that's actually in the language, a lease that was in existence prior to February 15th,
Correct.
especially if you're self-paying,
Okay. Our next question comes from Martha Sandoval, who asks, I see you are not using SUDA on your forgiveness calculation. SUDA was used to calculate loan amount. Can we not use for forgiveness
Oh, you
calculation?
can use SUDA. SUDA counts. What I said when I was running through my example, I said all my SUDA was paid in the first quarter in this example. which is common. I mean, it's capped. Every state has a cap for SUTA. So a lot of people just hit it in the first quarter. So they're not paying SUTA in the second quarter. And so I just assumed that there was no SUTA. But if you paid SUTA, it would count for sure. And it's actually on my sheet. So if you want me to show this sheet again real quick, let me just jump over, Austin.
Yeah, sure.
And so again, our clients, you don't have to worry too much. We're not trying to turn you into accountants, but what we are trying to do is make you understand the importance of this and know that we're not nagging you. We really want to be in front of this. So here's my sheet for actual expenses. And you can see I've got SUTA in here. So if SUTA was up $250 for that pay period, it would count. So total payroll, qualified payroll, $77.50, and it's coming out as should be coming out as $77.50. It looks like there might be a problem with this sheet. Oh no, it just splits it out. We've split out all the payroll costs. So there it is, the $250 for the $77.50. There you go.
And I would just add to that, if you're having questions on what are qualified expenses, we do go into that a little bit in more detail on our previous webinars. So definitely check those out if you still have questions on that.
Excellent. Let us know if we haven't answered your question thoroughly and we can get back to it. Our next question comes from Haroon Salimi, who asks, if we don't have to hire back the same people and the bank only looks at FTEs, then where does the no more than 25% cut in pay come into play? Jobs and responsibilities can change.
Right. Well, I mean, if it's not the same person and it's not the same job, it wouldn't come into play. This is specifically, you've got people that were, earning at a certain level. And I don't even know how they're going to, that seems like a lot of auditing to me to go from person to person. Not that I'm recommending that anybody cut pay. I don't think I would suggest that. I don't think it's going to make you popular with your staff, but theoretically it would be the same person, same position. You wouldn't cut their pay. And if you cut it over 25%, that's where it's an issue. So it has to be a pretty deep cut anyway. You literally take somebody from 20 an hour to 15. You just can't go any further than that before it affects your forgiveness. Does that answer the question? You can't cut somebody's pay that didn't work for you before. I understand what you're saying, and yeah, I agree.
Haroon, let us know if that didn't answer your question and we can get back into it and explain it further. Our next question is is non-taxable per diem paid to employees considered qualified wages?
Non-taxable per diem?
Yes.
I would call that an expense reimbursement. You're basically you're reimbursing meals and entertainment. No, I wouldn't think that would qualify. I mean, if I'm wrong and there's guidance to the contrary, we'll let you know, but I would not expect that to qualify. That's basically an expense reimbursement. Yeah, same thing like if mileage or.
Haven't seen that referenced anywhere, so I would be surprised if it was included.
Yeah.
Okay. Our next question comes from Kim Neerink, who asks, what's the requirement of hours for an FTE? Does it have to be 40 hours a week?
We don't know that yet. And to some extent, it doesn't matter. We looked back at a bunch of different tax law where you've had to calculate FTEs. And so like for the health insurance credit, for that new health insurance credit for small employers, it was 30. For the other FTEs, it was 40. But it's apples to apples anyway. So whether the divisor is 30 or 40, it's going to work out the same way, kind of, because you're going to have, it's just a different divisor, but it's going to be the same divisor in both periods. So it shouldn't matter. I mean, you could get a weird rounding thing, I guess, where they generally will round. So if you've got 7.7 FTEs, it's probably going to mean 8. So maybe you could lose on the rounding, but in general, I would say it's not going to be that important what the denominator is.
Yeah, they weren't very clear on it. That's why we're using our best estimate of it. But if you want to be conservative, use the 40 hours for a full-time employee. One thing you want to keep in mind is you don't want to count any hours over 40. So if you have people working overtime, they're already counted as a full-time employee once they hit that 40. It's not going to be in addition to any part-time hours that your part-time employees have. So once they're at that 40-hour benchmark, it's full-time. Anyone under that, you can go ahead and count as part-time.
If I got to count raw hours, Kellen would be 2 FTEs on most weeks. All right.
Our next question comes from Sherry Kelly, who I will bring in now. Sherry, all you have to do is unmute and you can ask your question.
Sherry, I'm so happy you're here. Somebody's got to help you unmute your microphone, but I hope that it gets done because I'd love to talk to you. There you are. Great.
Okay, so I'm curious to see if you've been shut down by the state, how do you bring your employees back when they're on unemployment?
No, I hear it. And I don't really have a good answer for that. Hopefully what's going to happen is you're going to get reopened in time to get some forgiveness. The problem is this loan is very specifically for payroll. It's the Payroll Protection Program. So you could get the loan, and if you don't have a way to pay payroll, you're not going to get any forgiveness, and it's okay. The risk is the 1%. So, but what I wouldn't do is borrow the money and use it for other stuff, because if you borrow the money and use it for other stuff, you're going to have to pay it back. And that amortization schedule that we opened with, would be very aggressive. So this is not a tool to, consolidate other debts or pay other bills. You definitely want to use it for payroll. So it's okay to borrow it, hope that you get back to work and that you could use it for payroll. But if you can't use it for payroll, don't spend it because you're going to have to give it back.
Okay.
Yeah.
Thank you.
Yep.
Thank you for your question, Sherry. Our next question comes from James Hood, who asks, can we further define the origination date?
Yeah. Again, the origination date is going to be the date that your loan was approved and you closed on that loan. So those are going to be pretty much the same date, should be the same date. It's not necessarily going to be the date that you received the funding for it, but those two dates should be in very close proximity. From what we're hearing, most people are receiving those funds within 2 to 3 days at the latest.
I think a great example of this is when you refinance a mortgage, anybody that's refinanced their mortgage to get cash out or something, when you do that, you close one day and 3 days later you get your money. The origination date would be the date that you closed on the loan, not 3 days later when you got the money.
Excellent. Thank you for your question. Our next question, if you do not have a payroll other than yourself, how do you do that? How is that considered? Sorry, I was tripping over the grammar.
Are we talking to a self-employed person, or are we talking to a guy that owns a corporation and pays himself payroll?
I'm unsure.
Okay.
It is an anonymous question.
So there's two ways here. So when you got the loan, when you got the PPP loan, you said, I've only got one guy, right? I've only got this one guy and I pay him $5,000 a month or whatever. And so you only borrowed a little bit of money anyway. And so it's going to be fine. That's assuming you're a corporation and you're employing one person. If you're self-employed, it's different. If you're self-employed, payroll is considered whatever you earned last year, 8 weeks of it. So we did do a webinar last week specifically for the self-employed. So it's a little bit different than what we're really hammering on here. I think self-employed, as a rule, they have it a little bit easier. We're certainly, our clients that are sole proprietors, 1099 people that got this loan, we will walk you through what your forgiveness is going to be. But there's a lot less tracking involved because those people just get the forgiveness kind of baked in because it's based on 2019, where employers have to prove up the cover.
They came in and clarified that they are self-employed. So reach out to any of the attendees, any of the panelists after this presentation, and we'll make sure that you get a copy of that self-employed focused webinar, which hopefully will answer enough/all of your questions.
Yeah, I would highly recommend watching that.
Yeah, that was very, very targeted for specifically that crowd. Yep.
Thank you for your question, though. Next is a follow-up question from Haroon, who asks, if we get our PPP money on the 24th, that 8-week period ends on June 18th. If there are 10 FTEs during the cover period, what do we do between 5/19 and 6/30 if we don't have the money to pay those 10 employees?
It's a good question. And again, we definitely need guidance on how they're going to calculate those FTEs. And when. They've nailed the date, June 30th. That's what they've said so far. But again, the guidance, I think, from the SBA is going to be quite a bit different than the vagueness of the bill. So we'll have to see. I don't know, but it's going to be a formula, and you're going to want to live with that formula. Right now, I would say that if you had 0 FTEs on June 30th, you're going to have a problem. That's the way it reads. I mean, if you've got no FTEs on June 30th, they're going to want their money back. That's the way it reads.
And they did say that they will issue additional guidance, but there's no timetable on when that's going to be. So, yeah, just use your best judgment.
As soon as there is, I'm sure we'll be hosting another webinar.
Yeah, or you probably.
Yeah.
If it's in the,
Our next question comes from Philip Faso, who I will be pulling in to chat with us. Phil, you're live with us. You just have to unmute yourself.
hey, Phil.
Hi, Pat. How are you?
Great to see you.
So, my question just is whatever money is left over and we have to repay it back, do we have to do it over a 24-month period, or can we just write a check and be done with it?
No prepayment penalty, and my intention is to just pay them back.
Yeah, why keep it? I mean,
yeah.
It is cheap money.
It's super cheap, but it's a harsh amortization if that's the way they're going to go with it. I don't know if they're going to call it a demand. I'm kind of preparing for the worst and hoping for the best, but there is some possibility that they'll amortize it over the remaining 18 months. And so, yeah, right. Why bother?
Okay. And the other question, I know you answered this, but clarify again. So I already received the $10,000 grant. I'm waiting for the PPP. Did you say something about we need to deduct that from the PPP if we receive it?
It's not that you deduct it from the PPP. What they do is at least my understanding is they're going to reduce your forgiveness. So I'll go ahead and I'll show you the example. And again, because this is important. And this is a great question. And so we've been trying to get clarification on it. And we spoke with the SBA one time, but assume that you're this guy. And so I'll go back to 0. So you got that 10 grand. And so really you could look at it a couple of different ways. You didn't get 71,000, you got 81,000. But that's not the way I look at it. You were set up for forgiveness of $64,919. But hey, I also got this EIDL grant. And so that's got to reduce the amount of forgiveness because there's no double dipping. You don't get to take both grants, basically, is the way that this thing is supposed to work. And so if you take that $10,000 grant, you can't take the PPP grant. And so what they'll let you do, though, is reduce your PPP grant by the $10,000 grant. The first time I read the thing, I thought, whoa, I don't want anything to do with that EIDL thing because it's not going to be anywhere near as much as the PPP. And so what they said was, look, if you already got the EIDL grant or you already got the EIDL loan, you've got to roll it into the PPP and we'll just reduce the forgiveness of the PPP because you were supposed to pick the benefit. And you got the one and you're trying to get the other. You're trying to get the bigger benefit. The only thing that's better about the EIDL grant is that there was really no strings on how you spent it. Once they gave it to you, you never had to give it back. And now the only thing that's going to happen is they're going to reduce your PPP loan forgiveness. So
But the EIDL, but the grant, you're limited. They have criteria on what you could spend it on, and one of them is not payroll. So that could be used on basic business expenses, paying bills, but you can't use it to pay rent.
Right, exactly. There was no strings. It wasn't like the PPP where there's strings attached to the PPP. There weren't a lot of strings with the EIDL grant, but it was way, way smaller in most cases. I mean, you've got people that are close, but it was way less money. And so if you had to pick, and you kind of do, you don't have to pick, but you can't take both grants. And if you had to pick a grant, you want to pick the larger one, and the PPP is a much larger grant in most cases. And so, but really all you have to do is just look at the two of them together side by side. How much can you get on a PPP? How much can you get on an idle? The PPP, if it's bigger, you're going to take the PPP and reduce your grant by the $10,000 idle.
Sure, but again, the grant is, you have to use it on different items,
It's
limited.
Yeah, well, the idle grant, the way I read the idle grant is once they give it to you, you don't have to give it back. So
Okay.
it's not like there's limitations, except that you have to disclose it because you can't double dip. That's the only thing you really need to be concerned with, is that, you know, at the time that they're calculating your forgiveness, it's going to be reduced by the $10,000 grant, even
Okay.
though I know they're two separate grants.
Great.
And Phil, you will want to disclose that if you're, you know, anticipating getting that PPP loan. Disclose that to the lender, because it's important. You know, it's not your fault that they just deposited it and while you're waiting on the PPP loan. So let them know that, though, because it is important when you look at the forgiveness period.
I also have a commitment from two different banks with loan numbers. I'm waiting for the first one to call. Did you say earlier that they funded this today?
Not necessarily funded. So what they did yesterday, the Senate passed a new stimulus package, which would provide additional funding, $310 billion for the PPP program. It has not passed the House yet. Doesn't mean that they won't make amendments to it in the House. It could, you know, possibly fold. I certainly hope. I wouldn't anticipate that that would happen, but they could change the amounts. They could change the terms of it. But hopefully, if all goes well, they'll get that passed sooner than later and get that additional funding in there.
Supposed
Okay,
to
great.
get today, I think, right? Right, Kellen?
I think tomorrow was the talk of them voting on it in the House. So hopefully very soon.
Excellent. Any other further questions, Phil?
No, thank you.
All
Thanks
right.
a lot.
Yeah. Thanks for attending and asking that question. Our next question, we're going to move on to Tony Brutti. Hopefully I said that correct. Tony, you're live with us right now. You just have to unmute yourself.
Hey, Tony.
Hello. Yeah. So my question was, so how long is the test period? Because if I get this loan, like say later, like say May 1st, would I have to spend it all by June 30th?
No, it's 8 weeks. It's 8 weeks.
Oh, 8 weeks. Okay.
Yeah, so it's 8 weeks after. And so that's where we're going to have to get guidance. You know, they really jammed this thing out, and
Yeah.
couldn't think of everything. Their concern was getting money out, and they certainly did that, $350 million worth. And they didn't think everything through. So the guidance will help us there, but it is an 8 week period. You don't have to spend it in 4.
Okay. Yeah. And then and there's other things too, like my test period. So we would have 8 full-time employees, but there'd be a lot of times where like a job, like we would go out to certain jobs, and if that job got canceled for a day or two, you know, they might only get like a 32-week check.
Sure.
So does everybody have to get paid for 40 hours throughout this 8 weeks?
No, that's why they use equivalents. So they just do the math. They'll give us a formula to do the math. But if you ever, 10 guys worked 350 hours, you would just divide that by 40, and you'd get 350 divided by 40 is 350 divided by 40 is 8.75 FTEs, and they'd round it up to 9 most likely.
Oh, I see. Okay. All right. So so it's not a person-to-person basis. It's like an hour. One person equals X amount of hours.
That's right. They look at the pool of people and they do the math.
Okay.
Yep.
Okay. Thank you.
Right.
Yeah.
Thanks, Tony.
Thanks, Tony.
Thanks for your question, Tony. Our next question comes from Greg Lopsiker. Let me just, as I pull Greg in, thanks for all these great questions, guys. I know we've been doing this for about a half hour now. We're going to work our way through, try to get to everything. So if you have questions, keep bringing them in. Greg,
great that you're here.
Yep. Hi, Pat.
Hey.
So I have 9 employees total. I haven't laid anybody off. I've got some money still in reserves. We're surviving. Let's put it that way. My goal is to get 100% forgiveness. And can we just go ahead, more or less overpay our employees for those 8 weeks? And then after that, I could kind of cut it back where, you know, so it's all fair, and like say in 16 weeks or whatever that may be after to square that up.
I want to be very careful here, Greg, because they do have language about prepaying expenses.
Okay.
And so I honestly would not think that that would be okay. I don't know if there'll be language in that. They haven't specifically addressed that. They were more or less, when they were talking about the prepayment stuff, it's like, I can't pay my rent for the whole year, right? Prepaying employee, though, I would think that that would be dancing on the line and maybe on the other side of it. A bonus is one thing, because a bonus is earned and that's not a prepayment. I would think that there may be an issue with, you know, literally just like, all right, I'm going to give you next month's pay during this covered period. I don't think that that's going to be acceptable. So I would be careful with that. But getting them to work more or hiring some other people, I think that's okay, and a better way to put it. Paying bonuses is, I think, fine as long as they're earned, but you can't pay the rest of the year's pay to jack up your grant, you know. So they'll probably put some more language in the guidance, probably. I would, but who knows, you know, it's the government.
So like January and February were the best pays that they've ever had. As long as I wouldn't exceed those, because March definitely with the COVID at the end, and then of course this month too, as long as I probably didn't exceed what I did in January, February, that really won't count because we're going back to last year.
Right. So it's FTEs. We'll use the test period. Well, you probably had 9 employees last year though, too. Is that true?
Yeah. Yep.
Yeah, so your FTEs are probably the same year over year. You applied for the payroll loan based on the average of 2.5 months of last year.
Right.
So you're probably going to be fine anyway, but let's crunch the numbers for sure. Get with Callie. I know she works with you, and I'm sure she'll help you fill this thing out and keep track.
Yep. Sounds great. Thank you.
All right, thank you,
Thanks
Greg.
for your question, Greg.
Yeah.
Speaking of Callie, our next question comes from Callie, who asks, can you go into detail about why we aren't recommending switching the payroll account to draft the funds from the PPP account?
Okay, so the reason I wouldn't do that, there's 2 ways. Originally, what we were considering, you know, so we put this escrow account together, we dropped the PPP loan in there, and we just had the payroll drafted right out of that escrow account. That was the original idea. The problem with that is not everything that would get drafted out would actually be a qualified expense. Specifically, your employer taxes other than SUTA, FICA, and Medicare are not a qualified PPP expense. So it's actually a little bit cleaner to transfer the money from the escrow to the operating as it goes out, because you could transfer the correct amount. If you just draw your payroll out of your escrow account, you're going to draw out a little bit too much, because you're going to draw out employer taxes that don't count. Does that answer the question?
I think so. If anybody has a follow-up question, ask it and we can find out that way.
Yep.
Our next question comes from Mary Lou McCann, who asks, what if an employee is making more on unemployment than their salary, and because of a safety reason, they won't come back and we can't hire someone else?
I had anticipated that issue specifically when they did the add-on to the unemployment. I was afraid of that. You know, it's hard to compete with stay home and get the same money, right? If you can't find somebody to hire, you're going to have a problem with your forgiveness. That's all there is to it. Unfortunately, I mean, I get the issue. I know why it would be an issue. So let's work through your numbers and see where you're going to land, and keep the money on the side that we don't expect to have forgiven. But it's good. It's a good question. And it's just good to be prepared. It's very important, much more important. I mean, waiting 8 weeks to figure it out is like people that come in for tax planning in February for last year. It's useless. All you're doing is recording history. You don't want to do this here, because there's opportunities for planning. If you're deliberate, you could optimize this thing, I think.
Excellent. Thank you for the question, Mary. Our next question is from Linda Recupito, who asks, what if you have fewer employees than 2019, but a higher payroll in 2020?
Yeah, you're going to have that problem. And that's why I did the FTE thing. I'm going to show you what would happen. Let me do that example again, just really quick. I'm going to go to the FTE test. So here's an example of that, or let's just make this, $70,000. I'm going to make it full forgiveness. I'm paying up, well, not 700,000. That's crazy growth during COVID days. But all right, so we should be at full forgiveness. We are at full forgiveness. We've spent all the money on payroll, every dime that we got. But during the test period, we had, let's say, 12 employees. And now this year, because we've hired better people, more expensive people, we've only got 8 people. Look at what happens. Even though I spent all the money on payroll, and this is great question, because I want people to understand this and be warned, I'm still going to have my forgiveness reduced because it's less people. And so the easiest way to think of it is in the extreme, I've got 3 people that work and I'm one of them. And because times are slow, I'm going to lay those 2 guys off and I'm going to take their pay. So now I took 100% of last year's pay, but I paid it to 1 guy. And that's exactly what they're trying to avoid with that FTE test. So if you have less people on payroll, you're going to have an issue. Let's crunch the numbers and be braced for it.
Excellent.
And thanks, Linda. I wish you would have come on. I would have loved to talk to you.
Our next question is a follow-up from Angel Gray, who I'll bring back. Angel, you're with us. You just have to unmute.
Yeah, hi.
Hi again.
I guess my question was, in the wording, it says that, you're working at an 8-week period of time that you're paying employees compared to a full quarter. Is that true?
Well, what you did when you got your loan, you got your loan based on 2.5 months of payroll, right? You got your loan based on 2.5 months of payroll, average payroll.
Mm-hmm.
And the covered period where you're going to get the forgiveness is 8 weeks. So yes, you did borrow more than your covered period, but they also are covering some other expenses for a 4th. So that's rent, utilities, and that stuff that we talked about in the other webinars. So it's not just payroll, but you do have to pay payroll, and that is going to determine how much of that other money you get for rent and utilities. I see your point. I mean, I get it. I mean, you got more money than 8 weeks payroll. You did.
Mm-hmm.
And they did that. That's kind of what they're giving us. They're giving us some operating expenses, but the rest of the money needs to go to the employees. That's the idea. We're going to give you 75% for your employees. You're going to give them that over 8 weeks. And you're also going to get some of your other overhead covered. That's the idea.
Okay.
Yep.
Thank you.
Mm-hmm.
Yep. Thank you for your follow-up question, Angel. Our next question comes from Vince Falaschetti. I did my best. Vince, you're on with us.
Hey, Vince.
Just have to unmute yourself. There you go.
Here we go.
Vince, we can't hear you. Are you there?
He tried. We could have him type his question in.
No, I have it. I have
Go
it.
ahead, man. Ask Austin.
Would it be okay to use the time period January 1st, 2020 to February 29th, 2020 for a seasonal business that only has 1 person on the payroll at that time period and has an average of 7 employees during the summer?
I don't think they're going to let you do that. They have a separate provision to keep it simple. We didn't talk about seasonality, but if you borrowed money, here's the problem. So let's even say that they would let you do that, which I'm sure they won't. But I'm not diving into seasonality here because it just doesn't apply to most people. But even if they would let you do that, based on the one, you wouldn't. Where would your numbers be? I mean, no, it doesn't work. It doesn't work because you based it on how many employees last year. 2.5 months payroll is not for 1 employee. They have a thing for seasonal employers, and I think that they're going to require that you use I think specifically what they say is you have to do that like period, which is the February 15th to June 30th. and they're going to compare it to this February 15th to June 30th. I will get back to you on that though, Vince. I will look at the seasonal rules, but I don't expect that they're going to let you say that you only had one employee.
Essentially, it's going to be, you're going to need to follow up with your account manager on it.
Kellen, do you know the answer to that off the top of your head?
I do know that they specifically did mention seasonal employers have different provisions in there. I'd have to look at it again to get the details on it. And I'm sure it's something that they're going to have to issue more guidance on. I don't think it was in full in there yet.
Yeah, they had a whole separate section regarding FTEs and regarding expenses even, I think, for seasonality. But we'll get back to you on it, Vince.
Yep. Thanks for your question, Vince. Hopefully we followed up or explained it well enough. Follow up if you have any other further questions. Next, we're going to move on to a question from Amy, who asks, if my salon isn't able to reopen by the expiration date, can I give back the PPP, but keep the EIDL to help with bills and utilities?
I don't think you'll have to give back that EIDL. I don't think you'll have to give that back. I mean, it specifically said, once you get it, you don't have to give it back. It would reduce, here's the thing that would happen. The EIDL, again, it reduces your maximum forgiveness on the PPP. And if your forgiveness is 0, you can't reduce something below 0. So you'd still get 0 on forgiveness and you'd hand back the money, I think is what would happen there.
Thanks for your question, Amy. Let us know if we can further follow up on that. Our next question, if you prepaid your monthly rent for the year in January for 2020, can you use the grant for that 2-month period?
Yeah, and I've seen this. I mean, you're going to have to, I'm going to want to be careful with this. I mean, it's sensible enough. You should be able to show them the lease, show them that I prepaid it and we're amortizing it over 12 months. On the other hand, the question is, how do you pay an expense prior to getting the money? How do you use money that you got today to pay an expense that you paid yesterday? I think there's logic in being able to do it. If it's a self-pay, like a self-rental, I would go ahead and give myself the 2 months rent and leave some of the other rent and prepay. If you actually paid it to a third party, then we're going to have to try to document it the best that we can. But if it were me and I were paying my own LLC or something like that, I would leave a couple extra months in prepay and go ahead and pay the rent for the 2 months because that's easy to document.
Thanks for your question. We're down to 2. Thanks for sticking through this marathon of questions and answer. We'll have a slight little wrap up at the end. If you have any other questions, get them in now. Our next question comes from one of our staff, Mary Lynn, who asks, how will they be checking what you do with the money?
Well, you're going to have to, provide documentation and everything. So one of the things that we're going to, and your account manager will talk to you about this, but when you cut that payroll, print that payroll journal. They're probably going to ask for, wage reports for the covered period as well, but print that payroll journal. When you pay the NIPSCO bill, scan the NIPSCO bill into your folder, and have it ready because they're going to audit the expenses. There's no question. They're not going to take your word for it. They're going to want bills. They're going to want payroll journals. They're going to want wage reports. And that's why we're getting in front of it.
Excellent. And now finally, if that employee refuses to come back to work, will they lose unemployment? And do we have to report that they've refused?
I suppose you could call unemployment and tell them that I offered them their job back. They give you a period of time when somebody goes on unemployment to protest. And by the time you're mad at them for not coming back, it's too late to protest. So I don't know that that's going to go anywhere. And I think it wouldn't be a fruitful use of your time. If your employees won't come back, the way that you punish them is you get somebody else and you don't give them their job back. They're only going to get 4 months of unemployment at that souped up rate. Mm-hmm. And then their unemployment's going to run out and they're going to want a job again. So, I get it. And on the other hand, I could have empathy for them because it's I get more money in some cases to stay home and not work versus coming into work and I get a little bit less. So I knew this was going to be a problem when they did that crazy thing. They should have done a lot of things, but I'm not in charge. You know, I would have capped it at 100% of wages or something, or 80% of wages, but they didn't ask me. So this is what we're stuck with.
Yeah, get paid more to not come in and not get sick.
Right, right.
Well, those are all the questions we had. Thank you, everybody, for your questions, and everybody else for sticking through. I got a couple things left to talk about. We'll move on to the actionable steps. What we recommend: get with your account manager as soon as you can. Either they'll reach out to you or you can reach out to them, and they'll prepare a preliminary estimate of your forgiveness and create a plan to document all of the usage of your loan funds. After that meeting, schedule a follow-up so that you can review where your forgiveness is at after 4 weeks. And then if you have any loan balance outstanding, be prepared to repay any of that will not get forgiven. You know, don't get wild with your usage. And then finally, if you've seen our webinar before, I'm sharing, right? Am I sharing the right thing?
You got it. We see your website.
Remember that we have our client resources coronavirus update page, so you can stay on top of any of the upcoming news. But I also want to show you something cool that we've added. We have a new virtual front desk. Our office is undergoing reduced hours right now, and if you need to speak with a receptionist or a professional right away, you can enter the virtual front desk. It's a Zoom meeting that's always open to speak with a receptionist right away and get you in touch with a professional as soon as possible. It's convenient, easy from home, and has all the convenience and time saving that a virtual front desk would provide. So that's all I've got for you today. Pat, Kellen, do you have anything else before we wrap this up?
Yeah. Thank you, everyone, for attending. We appreciate it. We appreciate the questions. If you do have more questions, reach out to your account manager. They're going to be glad to help you.
Yeah. Thanks, everybody. Thanks so much for coming. We appreciate it. And let's stay in front of it.
Yeah.